Thanks for joining us today on Market Call. I'm Morella Fernandez. Martin Cobb with us on the show. He's Senior Vice President Equities at Lorne Steinberg Wealth Management. He'll take your questions today on U.S. and Canadian equities. Here's how to reach us. 1-855-326-6266. If you'd like to call in, you can email questions in as well. marketcall@bnnbloomberg.ca. Martin, we have an intraday high for the TSX, so a little bit crazy. Last week dragged down quite a bit, some recovery this week, but you kind of never know. What's playing out?
Yeah, there's a tug of war, it feels like. As we've talked about over the past probably 2 years now, the whole AI narrative, which I think was suggested, some of the performance we've seen is perhaps investors are getting a little bit tired of that or a little bit circumspect about it. On the other hand, you still have good earnings, growth from a number of entities, here in Canada. We were talking about the banks earlier on the show, on a previous show, gold stocks. There's still a lot of good underlying earnings momentum. But there feels to be a little bit of optimism baked into investor expectations, maybe too much so.
I was going to say, so they're still worried about valuations. They're still worried about return on capital?
Yes. I'm certainly worried about return on capital on the whole AI side, which we've talked about in previous cases, that there's just a number of these entities are not making any money. But valuation-wise, here we are in Canada. There used to be Canada was trading at a big discount to the US. That gap is closed quite markedly. It's still a discount, but not massively so. And based on a number of metrics, the S&P 500 looks quite expensive. So, but you can find evidence to support your view. If you believe this is a bubble, not a bubble, middle of a bubble, you can find evidence to support this particular view.
What are you paying attention to these days? If investors are sort of now looking at tech, feel unsure, wanting to put their money elsewhere, what are you looking at?
What they're not looking at. So, John Templeton talked about times when he was asked by clients, what's the best stock? Where's the outlook the best, the brightest? You say you're asking the wrong question. Where's the outlook the worst? Because that's where you will find bargains. I kind of like the middle ground, the apathy. What's no one talking about, today in terms of markets? And there's a number of businesses that haven't really changed, and they still continue to do what they do, but no one talks about them, and that can tend to lead to that period of apathy, and valuations get compressed. And then we can find something that's quite attractive to buy on a multi-year view. So avoiding the noise, looking long-term, and trying to take advantage of Mr. Market, not being informed by him.
If historically this time of the year tends to be stronger, is this just an off year? Is this just an off period because of AI? How do you look at this time of the year?
Yeah, November and December historically have been the two best performing months going back for the last century. But then September and October are usually the two worst months. And we had some good, performances in both this months this year. So, the averages are always there to kind of misguide you to some extent. I just feel we came into November this year with a lot of expectation baked into, a lot of good expectations baked into valuations, very strong performance, on track for another 20% plus year in the TSX, which is almost unheard of. The S&P on track for, 6 years out of 7 of double-digit returns. There's a point at which investors just get too enthusiastic. I suspect that's what we're seeing unfolding in the markets in the last little while.
Okay. Let's take a quick break. We will line up the first phone calls and emails for Martin Cobb, Lorne Steinberg Wealth Management. To take your questions today on U.S. and Canadian equities, here's how to reach us. We're back in a moment. Welcome back. Thanks for joining us on Market Call. We're going to start with an email from Ryan, who says, could I hear an opinion on Take-Two Interactive? Also, do you think GTA 6 is fairly priced? We'll turn that over to Martin. So Take-Two, of course, I guess entertainment software?
Yes, it's video gaming software. I have a soft spot for Rockstar Games, who developed the GTA, the Grand Theft Auto franchise, because they're from Edinburgh. The developers still live and actually work in the same building that my first company, Baillie Gifford, resides in. So that's irrelevant, though, when it comes to investing. That being said, here they are. We're talking about Grand Theft Auto 6. Grand Theft Auto 5, one of the second best-selling title of all time, second only to Minecraft. Released in 2013, had a great launch and then did very well during the pandemic as everyone went back onto playing computer games. We're waiting for Grand Theft Auto 6, which has been delayed again to next year. it's likely to be a huge title for them. The problem is there's not much else with Take-Two Interactive. I don't like any type of company that's got a one-hit wonder, and this really is. They do have Zynga, the mobile business. They have a number of other franchises, 2K in the sports side, but really it's all about the Grand Theft Auto franchise. And the stock is priced for success of Grand Theft Auto 6. It might well succeed, but you want to buy it if it's not priced for that. So to answer the question, is it fairly priced in? It's more than fairly priced in. They need a very successful launch of Grand Theft Auto 6 on time and to exceed expectations. I think the risk reward is not particularly favourable on the stock today. I mean, it's been loss-making the last 2 years because of the absence of a hit title.
And what has led to delays?
Well, GTA 5, 2013, we're looking at a 13-year development cycle. And these are huge enterprises now. I remember the day when people laughed at the idea that the video gaming industry would be bigger than the box office. Now it dwarfs it. 4 times the size annually, the sales of video games versus what you see in the box office. And these games are so complex and have to be so good. So they're trying to polish it. It's going to take a year and a half to polish effectively. That shows you, just the size of these games, the complexity, the number of people involved, the amount of money that is spent just to get this on the shelves. And then don't get any pushback from users finding they've got glitches in it.
Got it. Okay. Let's go to our first phone call then. Peter's on the line. He's in Niagara Falls today. Hi, Peter.
Hi, good afternoon. Thank you for taking my call. My question for Martin is on C&Q. I noticed on Monday, RBC just upgraded it to a very strong pick with a $62 target. I noticed it's paying a 5% dividend yield, which I find very attractive. Can you please give me your opinion? Thank you very much. I'll hang up and listen.
Okay, thank you for the question. C&Q, with the price of oil, feels like it just hasn't really done much for most of the year, and it's had a bit of a wiggle sort of more recently. But can I get first your take on the space, specifically not natural gas, but oil resources?
Yeah, there's a number of bodies, in particular the IEA, who come out with forecasts for oil price pointing to the glut for next year.
Yes.
Their history or their track record on making forecasts is not particularly good. So I would take that with a pinch of salt. But there is a lot of potential supply coming on next year, and that's concerning the market to some extent. I spent several years running Templeton's energy team. I spent a good portion of that writing a white paper on how to predict the oil price and came to the conclusion there really is no ability to do that. Just look at the forward curve. So if you're trying to buy something like a C&Q on the basis of an oil price forecast, I would say forget it. There's much more attraction about C&Q as a business, regardless of the oil price environment, which ultimately, over time, will have to be above the marginal cost.
Okay, so you agree with the strong buy recommendation at this point?
Yeah. Goes back to what we were talking about earlier in terms of apathy. People come onto the show and talk about gold stocks today. Maybe less people get invited to talk about oil stocks, and there's just no one's really talking about them. The reason we like C&Q is a number of reasons. One, it's break evens. If you go back to 2022, it was still free cash flow positive. That's when the oil price was very weak. It's WTI below 39, and it's still making money. Great capital discipline. Love the way they communicated what they're going to do with paying down debt from the recent deal. They've done some infill acquisitions. So ultimately, it's not a call on the oil price. In fact, it's almost the opposite. As long as the oil price is constructive in a long-term sense, this is a very well-positioned, low-cost, reasonable growth entity that generates a lot of cash flow, has excellent stewards of capital, and will pay a growing dividend over time.
Okay. I hope that's good for Peter. Let's move on to Elliot. Elliot's calling today from Hamilton, Ontario, with this question. Hi, Elliot.
Good morning. Please, down 10% or more from its high and below its 200-day. What are your thoughts, please, on Waste Management? And would you buy it today? Thank you.
Thank you for the question. Waste Management.
I like the waste companies. I mean, whether it be here in Canada, the US, my home country of the UK, they have wonderful assets. It's impossible almost to get landfill, permitted today. So you have these wonderful assets. And then you just have the ability to recycle, the ability to do a lot more things with incineration, et cetera, in terms of waste. And it's just the asset. It's just so hard to replicate these types of businesses because simply you won't get permission from the various governments to do so. The problem with that is the valuation that comes with these. They typically trade on something like 40 times plus earnings,
okay.
which is high. And I kind of get it because of the the nature of the asset and inability to be replaced, et cetera. But when you're getting starting yield of like 2.5% earnings yield, yes, there is some growth. It's a little bit rich. So easy to say. I always like to buy stocks cheaper than they are today.
Sure.
Don't we all? But ultimately, these are quality businesses that I would love to get on sale if we have a bit of a market dislocation. If you owned it today, yeah, tuck it away for 10 years, you probably do all right.
Are they dividend paying typically?
Not a huge amount. I mean, if you've got a 40 times price earnings ratio, it's turned into free cash flow. That's a 2.5% free cash flow yield. You can't pay a particularly big dividend and grow all that much. So the dividend yield is not high on these entities because they simply don't have that much free cash flow to pay it.
Okay, Elliot, I hope that's good for you. Let's go to Mark. He's in Coburg, Ontario, with a question. Hi, Mark.
Hi. Thank you for taking my call. I'm interested in the payout ratio for Telus and what we see for the future of Telus. And thank you for taking my call.
Thank you for the question. There have been discussions about Telus paying its dividend moving forward. What is your take on whether they can continue to pay that dividend moving forward?
I've seen this story play out so many times that you have an entity that commits itself to a growing dividend. That
9% dividend?
9% dividend yield.
Dividend. Okay.
It's a high dividend yield. And my rule of thumb is once you get above 8%, there's a dividend cut coming. It's a rule of thumb. Doesn't mean it's going to happen. It's the payout ratio, particularly if you have to take out the dividend reinvestment plan, which saves them something like $800 million dollars a year. They are over distributing. There's not a huge amount they need to do in terms of investment. They're not growing particularly fast. But ultimately, the market is telling you that dividend is going to be cut. And it probably makes a lot of sense. There's no free lunch in dividends. I do sometimes meet clients who talk about this wonderful dividend yield. Well, if a company pays a dividend, the rump of the business goes down by the same value. There's no free lunch. And I think we get a little bit too enamored by dividends at time. And ultimately, when you get to a point where the payout ratio is too high, and I think that is the case with Telus, it will be cut. But then look what happened with BCE. Cut the dividend, and investors kind of cheered it, applauded it to some extent. So I think it would make sense. Actually, it would make sense. Will they do it or not? Well, that will be up to management. But I suspect, given this discussion has started, they're probably feeling a little bit more pressure to do it today. And I don't think it would be a bad thing.
Okay. BCE, of course, parent company of the channel under the Bell Media banner. Let's take a quick break. Back with Martin Cobb of Lorne Steinberg Wealth Management. Taking your questions today on U.S. and Canadian equities. We're back in a moment. Welcome back. Martin Cobb is with us today to answer your questions. Let's go to Michael. He's on the line in Vancouver. Hi, Michael.
Hi there. Thanks for taking my call. I think Tesla's up to about $4.20 per share from they bought it out about $100, but I think Elon Musk goes, that's $1 trillion, not the other way around. Is Tesla a good investment for investors? Thank you.
Okay, thank you for the question. Tesla sitting at $4.20 is where I have it today, so it's up a little on the day. But we talk about valuations.
Yeah.
And you look at a company like Tesla. First of all, do you see it as a car company? Do you see it as a technology company? How do you view it, first of all?
I view it as both, and I value it accordingly. So I think you have a very good, arguably, premium car company as part of Tesla. And I value that, if you were to value it, and that's how I would choose to value it, along the lines of, a BMW, premium mark, et cetera, the sort of margins you would earn. You'd probably value that about $100 billion, give or take, maybe 150. So the problem is the other bit, the other several $100 billion worth of value is a technology company. Okay, you have a solar business in there. You have the dream of various robotics, AI-enabled robotics, humanoids, etc. And I can't value that at anything like the sort of numbers that the market does today. So that's the problem is you have to believe it's more than a car company. I mean, I remember when Tesla was really on fire, you had individuals on BNN or CNBC talking about it was going to absorb the whole energy industry, so electricity, grids, power walls, because you have to believe that. I simply think the probability is not in your favor that Tesla is likely to achieve the level of profitability in its other business to justify even double the valuation of the car company. So to me, it's one of the most overvalued stocks in the market. And
you wouldn't hold it, or would you have sort of?
I wouldn't say rush for the exits, but you are basically playing the greater fool three, in my view, in Tesla, that you are owning it today, you are believing someone else is going to pay a higher price in the future. That could easily happen. As we know, valuations don't matter in the short term. Over 1, 2, or 3 years, there's a lot of hype, a lot of speculation, the genius of Elon Musk, etc. I prefer not to play that particular type of game. The risk reward is not attractive.
Okay. Let's move on to our next caller, Ross in Windsor, Ontario. Hi, Ross.
Hi, thanks for taking my call. I have another question about garbage. Waste Connections, the guest's opinion on Waste Connections, if you could. Thanks.
Okay, thank you for the question. So when I was listening to you talk about sort of the waste space and why it tends to be a good one, it reminded me of railways, right? No one's going to lay down another railway. They kind of own the spot. What are your thoughts on Waste Connection?
I mean, very similar to my answer on waste management. The only difference being is WM has the Phoenix Open, which I watch every year, the golf, which is one of the most raucous atmospheres you ever see in golf, and Waste Connection doesn't have that. Other than that, almost identical answer. Wonderful assets, irreplaceable assets, huge economic moats, steady, predictable, earnings per share and free cash flow. It's just that valuation. We're just in a market environment, have been for quite some time, where anything that's seen as being predictable, solid growth just has a valuation that is up there. I'm not saying it's ridiculously valued. It just feels a little bit rich. And we've seen a number of companies in this last little while just see the valuation compressed to some extent. And there may be an opportunity to pick up some more. Again, a 10-year view, probably okay, even if that valuation compresses to the mid-30s. I think at 30 plus is probably the right number for it. It's just it concerns me how richly valued it is today.
Okay. Ross, I hope that works for you. Let's go to another caller, Ray's in Colwood, BC. Hi, Ray.
Hi, thanks for taking my call.
Go ahead.
I'm calling about Interfor. I've been following this company for about 6 or 8 months, looking for an entry point. It's one of the third or fourth largest lumber producers in North America. I think it does like 4.5 billion board feet. I'm ex-military. I'm retired. This is for a 5-year hold. I'm looking, or more, maybe even 10, 15, but for now, 5 year or more. And I'm looking for an entry point, seeing if this little jump here is in the last few days is an indication that maybe this is oversold and it's time that it's hit a bottom and might see it go sideways for a while here.
Okay, thank you for the question. So Interfor up about 18.6% in the last 3 days, more in the last 2 days than the last 3 days, but an announcement coming from Ottawa as well about support for steel and lumber. Does it look to you like it's hit a bottom at this point? Is this a share or a stock you would be worried about dropping down even more?
I'm not a fan. I'm not a fan of this and West Fraser. And I think actually, my old preference for West Fraser. I look at these types of entities, the lumber companies. They're low quality businesses. They're price takers. Yes, politics and tariffs and trades or relief therefrom, can maybe give you a little bit of a fillip in the short term. But ultimately, they're not great businesses. They have loss-making years as well as positive years. Interfor has quite a lot of debt, so it's more leveraged, to how its operating business is doing. So I almost feel like asking the question, why are you looking for an entry point? I do believe if you have a 5 or 10 year view, which all investors really should, you could buy something like a Stella Jones, which uses their products and makes kind of enhanced wood products for residential, but also the likes of railways and poles for electricity, and much better business, much greater compounder, higher returns on capital over time. So if you've got a 5 to 10 year view, take a look at Stella Jones instead of Interfor.
Okay. Let's go to an email then from Cozy, who says, what do you think of BlackBerry stock and the future for BlackBerry? BlackBerry, they essentially do software now, I guess is what it is, security kind of software?
Yeah, BlackBerry, what a change over the last 20 years. I remember when I got my first BlackBerry, and I was reluctant to some extent because it just meant I was always able to be communicating with my boss. But no, today it's a software company. There really is no hardware. I mean, you think of the death of the hardware companies like BlackBerry, like Nokia, Ericsson, they've all just kind of frittered away in terms of the handset market, and BlackBerry has become a software company. Has some good software. But it's just, I think it's still somewhat, we as Canadians, like to think of BlackBerry as this great technology company. It's a bit of an also-ran to some extent. They may have some products that they do well, but we prefer something like an OpenText. There's just some other companies I'd rather have investments in than BlackBerry.
Would you take your money out of BlackBerry if you had money in there and then sort of put it to work somewhere else?
Yes, I think so. Yeah, I think there's a bit more hope with BlackBerry that they have something that's very differentiated, and I'm not convinced it is. I'd rather look for something that's cheaper, like an OpenText, or perhaps something that has a little more of a moat in terms of software, a little bit competitive advantage.
Okay. We're going to take another quick break. We will line up more of your phone calls and your emails for later in the show. And when we come back, a look at past picks. Stay tuned. Welcome back. Time now for a look at past picks from Martin Cobb. These are February 5th, 2025 picks. At the time, Martin chose Saputo, SAP on the TSX at 24.03, and now up to 39.46. So 64% upside, a 67% total return. Saputo, I think of as a cheese company.
Yeah.
What did you like about Saputo at the start of the year? And this would have been before sort of Liberation Day, I want to remind people.
That's right, yeah. Who would have thought cheese could be so
valuable, yes.
It's really, I mean, when I talked about Saputo back then, it was much unloved stock, particularly the reason being what's happening in the US business, which is most of the food service side. It's more commoditized. It used to be their most profitable division. We would make something like 10% operating margins, and it was actually into losses. The milk cheese spread, pardon the pun, was just really has been against them the last couple of years. They continue to make good money in the retail business here in Canada, the UK, and Australia. But they've been doing a lot of self-help. So you had a compression of margins from the market in terms of industry conditions, but also in terms of the company's own investments. And they're now starting to harvest some of the fruits of that. The industry conditions are still pretty tough, but the margins have been picking up and they've had a couple of good quarterly results. The big difference, though, is investors kind of loathed it. It was on 11, 12 times earnings, and they've kind of embraced it. Now it's on 17, 18 times forward earnings, slightly improved earnings. So the stock, as you can see, has done very well. So it's starting to feel like glass half full versus glass half empty.
What's been a drag on the industry?
What happened? Well, I was reading, despite Ozempic and all that, US consumers are consuming an awful lot more cream and butter than they have done for quite some time. It's at record levels.
Interesting.
I know, yeah, you would think that they would have been eating less.
Yeah.
And so that has been drying up the demand for milk. At the same time, there's been an overcapacity in the cheese market, in particular in the food service side. It really suffered a bit in the pandemic, hasn't really come out. So it's just a more commoditized type market. I mean, if you go back historically, I'd say Saputo made very healthy margins south of the border. It's just been tough for the last 2 or 3 years. I expect some recovery, maybe back to 5%, not 10%. But the stock is now starting to discount, that recovery and some, given the valuation.
All right. Let's get to your next past pick, Smith and Nephew SNN on the New York Stock Exchange. 26.12 at the time you recommended it in February, up to 33.50 US today. So a return of 28%, a 31% total return. This is a company that does medical devices. Tell me a little bit more about them. Are they sort of a big distributor? Is this a stock that you are going to hold on to? And if you are, why?
Yeah, they are a medical device company, a bit like Stryker, probably a better known name over here. So if you go to the hospital to get a knee or hip replaced, or you have a sports injury, soft tissue issues, advanced wound care, those types of products that serve a heavier, older demographic, but also the sports side, which is a younger demographic, then you're likely to get a Stryker or a Smith & Nephew, a Zimmer Biomet, or a DePuy, which is part of Johnson & Johnson, one of those products. It's an oligopoly, those 4 companies. So they had it's kind of elective surgery to some extent. You can delay it. So they had a very poor pandemic as people decided to push back on that.
Sure.
So the stock got very attractive. It's 5% kind of industry growth. They should enjoy something like that level of industry growth, a little bit of margin improvement. And I just view them as a discount for domicility. They're based in the UK, although it's a predominantly US business, and they trade on almost half the multiple that Stryker, which is a slightly better business, slightly higher market shares, et cetera, does. So you're paying 15, 16 times earnings. Stryker's more like 26, 27 times forward earnings. So still see a lot of upside in the business, both in terms of continuing operationally, but also in terms of the price that investors might pay. We like it. Okay,
let's get to your next past pick. Electronic Arts, EA on the NASDAQ at the time was 130.47 US, now up to 201.93, 55% upside, 55% total return as well. Electronic Arts, another sort of entertainment software company. And how does it compare to the ones we talked about in the past? And is this something you're holding on to?
We won't have the choice of holding on to it because it's been bid for by a consortium funded by the Saudis as well as Jared Kushner, et cetera, 210. So today the price is about 202, should settle sometime probably in the second quarter. So we've got 4% upside. On an annualized basis, maybe 8%. In the market today, I don't mind having 8%, annualized upside. What I liked about this one, it's the most utility-like of the video gaming companies. Very much the opposite end of the spectrum from Take-Two, which is dependent on really one franchise. They have so many different entities as part of the. So it never had the kind of one-hit wonder. The annual titles would be released in the sports side would just kind of be incrementally positive. But if you go back to February, the reason I liked it is I just compared it to Activision Blizzard, which was bought by Microsoft, roughly the same sales, and Activision Blizzard was taken out at roughly double the price of what Electronic Arts was trading at that time. So whilst I wasn't predicting the deal would happen, to me, with content being acquired all the time, this was an opportunity to buy on a standalone basis an attractive company that ultimately someday someone might come along and buy it. Happened a bit sooner than I expected.
Okay. Let's take a quick break then. Martin Cobb sticking around to answer your questions on U.S. and Canadian equities. We're back in a moment. Stay tuned. Welcome back to Market Call. Let's go to Jacob on the line in Toronto. He's got a question today for Martin Cobb. Hi, Jacob.
Hi, good afternoon to both of you. Sir, I would like to ask you about CVE. Is there an entry point to it, or it's just let it go until the next year? And besides, I just want to ask you about, was it a smart move to buy this big company, Meg Energy, at the time that the energy is going down so much? Thank you very much.
Okay, thank you for the question. So Cenovus is what we're talking about. It's sitting at 24.61. Today it took over Meg Energy and absorbed and trades now just under Cenovus. First of all, what did you think of the deal?
Yeah, sensible deal. It's a bit like what we were talking about C&Q earlier in terms of some of the deals they've done in their backyard. Kind of makes sense. I remember the times when there were some great deals, seen as great deals done by big companies buying in different parts of the world to tap new basins, etc. Buying something that you know pretty well, kind of makes a lot of sense. So I do like when commodity companies in particular stick to their knitting, and this ticks that particular box.
Okay, so what do you think about it moving forward? It's at 24.60, had a high earlier in the month at 25.89. Would you dip in here? Is it enough of a dip?
Yeah, I always am a bit hesitant to talk about entry points. If you're trying to buy a stock on a 3-month view, then you probably all you want to focus is on your entry point and your exit point. But again, goes back to the sort of discussions I was talking about. A constructive oil price environment, a reasonably good operator. They're a bit more integrated than C&Q in terms of downstream activities. But ultimately, this is a sector where there are a number of companies like Cenovus, like C&Q, that I think if you have a 5, 10-year view, you'll be served very well in terms of the free cash flows, the dividends, the growth, and who knows if we get an oil price, period of strength for some time, some icing on the cake.
Okay. Jacob, I hope that's good for you. Let's go to Bruce. He's in Simcoe, Ontario, with a question today. Hi, Bruce.
Hello, and thank you for taking my call. I would like your opinion on BlackRock.
Okay, thank you for the question. BlackRock, let's have a look at that chart and pull it up. What are your thoughts on BlackRock?
I remember BlackRock as being this. I worked for Franklin Templeton in Edinburgh, and there was this company called BlackRock, which was a relative minnow compared to us at that time.
And not anymore.
Not anymore. And one has to take their hat off in terms of how they have built that business in terms of diversification. The whole iShares business that they've done particularly well. If you want something, BlackRock will give it to you, and they've been very good at effectively dealing with the pressure on fees, both through scale, but also just being part of that. They've been part of the problem for the rest of the industry. So I like BlackRock strategically. It's a great asset gathering business. Yes, there are pressures on the business, but they handle them, better than most. It'll probably be around another 10, 20 years as a behemoth that it is today. Been very well managed in terms of thinking about the types of products that customers want. So I like BlackRock as an entity. Yeah.
Okay, BlackRock there. Let's go to Paul in Orangeville, Ontario, with his question today. Hi, Paul.
Yes, AYA, silver and gold. It's got 2 mines in Morocco, and I don't know if the second one is just opened or is going to open the next year. What do you think about the condition it is now and for the future?
Okay, so gold and silver is what we were talking about. It's up 22, almost 23% on the year to 1610. today. Is Morocco a reasonable place to run? I've heard some of the miners who have assets in Morocco, and they love it.
Yeah.
Is it fairly stable for these kind of operations?
Yeah, although I would say yes, and today it is. And, there's a number of mining operations in Morocco. You think of, there's, the, not potash, the other one, the phosphorus, for agricultural chemicals. They have a lot of phosphate mines there, which have been running for decades, and they're a pretty sensible kind of quasi-European just across, for the water from Spain. So they're pretty sensible. That being said, I remember times there's been geographies where people thought they were sensible and then something changed and they weren't. But Morocco does appear to be fairly sensible in terms of the rule of law, protecting of intellectual assets and property, etc. So I kind of like that. So I think Morocco's quite good, and it looks to have some interesting mining prospects in gold and other assets. And then you have the whole gold price, which we can debate about till the cows come home. We know central bankers have been buyers of gold. Actually concerns me to some extent because they're terrible investors, central bankers. They tend to buy at the top and sell at the bottom. Okay. But you've had obviously, not speculative interest, but retail investors, ETFs and stuff. So I'm fairly constructive on the gold price, longer term. Maybe it's overshot in the short term. But what I would say to the caller is just be mindful of the position size you have in something like this. It's a speculative asset, ultimately gold to some extent, and a more speculative vehicle in terms of IA gold. So just be mindful of your position size.
All right. Let's move on to an email from Jim. Jim says, is it a good time to buy Costco? So Walmart reported recently had to pass through some of those tariff costs, of course, to customers now. Costco, we looked at the start of the year, was doing very, very well. It's kind of trended downwards now for a little while and sideways. So at $909 today, but still up, 69% or so over the last 3 years. Is this a business that you think will continue to grow given the times we are in, weaker consumer, that kind of thing?
If there's a better business model in retail, I've yet to find it than Costco. Why do I say that? Well, the flywheel effect. They have what's called a flywheel business, that they use their scale to achieve very low prices from the suppliers. You cannot supply anyone else lower than they supply Costco. And they don't keep that. They pass it on to the consumers, which drives footfall, which drives revenues, which gives them more scale, which allows them to negotiate better prices. They fix their gross margin between 12 and 13% every year. So there's a lovely flywheel business. Then you have the membership fees, which are an annuity, which you could either argue cover a chunk of the overheads or a pure profit. Again, great business, allowing them to keep prices low. And then you have Kirkland Signature, the private label.
Products,
Twice the size in terms of sales of Coca-Cola. It's that big. And again, gives them that leverage over, a lot of other consumer packaged branded companies in terms of ability to drive prices. So the whole thing is just so well set up for continued growth. They have 900 stores around the world, opening more internationally, but the US is still about 3/4 of the business. As I say, I don't think there's a better business model. Always looks expensive, but this drift we've seen back in the last little while is getting close to 30, something in the 30s in terms of forward multiple. Is starting to pique my interest to some extent.
Okay, one to watch. Let's take a quick break. Martin Cobb here to answer your questions on U.S. and Canadian equities. We're back with your phone calls and your emails in just a moment. Welcome back. Let's go to Robert. He's on the line in Scarborough, Ontario, with a question today for Martin Cobb. Hi, Robert.
Oh, hello. Thanks for taking my call. My question is on Thomson Reuters, TRI. This company has had solid returns in the last 5 years. I own it, but it's taken quite a tumble in the last few months. My question is, do you own this company? And if not, would you buy it here during this correction?
Okay, thank you for that question. It's down quite a bit. So it's 186 today, but quite the drawdown since summer. Any reason you see for this? And can you expand sort of on the business that they run?
Yeah, Thomson Reuters, we don't own it. We launched a Canadian dividend strategy in early 2020, and it was one I did quite a bit of work on and just couldn't quite stomach the valuation. I've looked at it subsequently and couldn't quite stomach the valuation. They bought the Refinitiv business from London Stock Exchange Group. I looked at it again, still couldn't quite stomach the valuation. It was it does data, all sorts of types of data for legal, for finance. A lot of the stuff is just, we were discussing it, just drives the backbone of a number of enterprises in terms of their data needs. And it seems to have a very surprisingly maybe high economic moat in terms, in the world of, you would think with big data and AI and stuff. So they seem to be very well positioned for that. There is always the competitive threats, and there maybe are some fears today. Those competitive threats are perhaps increasing to some extent. So we don't own it. I would say with, investment horizon of being several years, as always, and I keep thumping the table saying that, you shouldn't worry about drawdowns. We have drawdowns all the time. If the business is still attractive, it's still growing its revenues and earnings and distributions to shareholders, you should celebrate drawdowns. It gives you the opportunity to buy some more. And I think Thomson Reuters is kind of in that camp today where they're, like a number of businesses actually, even just Costco we were talking about earlier, where the valuation is compressed to some extent in this kind of unusual market environment. So take advantage of Mr. Market. Don't be informed by him.
Okay. Let's move on to our next caller then. Nain is in Windsor, Ontario with a question. Hi, Nain.
Hi, thank you for taking my call. I was just wondering about IA Financial. What your thoughts on that?
Okay, thank you for the question. IA Financial.
Yeah, we don't own IA Financial. We own, on the life side, the Sun Life and the Manulife, which we prefer as businesses, particularly because, to some extent, their asset management business and the growth you're having in Asia and other areas, there's maybe a little bit more growth there. IA Financial gives you that kind of combine of the insurance business and the asset management business to some extent. Going back to what we were discussing, BlackRock, and just the pressures on that asset management business remain intense. So you're left more with the business in terms of the insurance side. I prefer to have something like a Manulife and a Sun Life, which you say have got those bigger asset management businesses abroad and have exposure to the growing savings rates you see in the likes of Asia, etc.
Okay. Nain, I hope that's good for you. Let's go to an email then. We have an email today from Prince Edward County in Ontario from John. He says, can you recommend a small to mid-cap ETF? Are there a lot of small to mid-cap ETFs?
There's a number. I mean, I'm not sure we can get one for Canadian equities, but there's certainly a number of ETFs that give you exposure to the US or even world. I believe, BMO does some products that are possible that give you exposure there. First thing I would look at, one, is it a reputable provider, like a large company? Two, what are you paying for exposure to that? So the ETF charges, will be absolutely key. You shouldn't be paying more than 30 or 40 basis points. I would assume there's something out there at that sort of level. Don't pay for active, management in terms of the ETF space. I think that would be a mistake. And I think the whole idea of the asset class, I mean, I remember the days when small and mid caps traded at a premium to large caps, had better growth. Those days are gone, long gone. That being said, we are seeing a pickup in M&A. We've talked about a couple of stocks already today in terms of that have seen acquisitions. So you might see that gap between small and medium-sized companies, the valuation gap, close to some extent. So I think it's an interesting question, and in terms of diversifying, down from the mega caps. I mean, you can get an S&P 493 ETF, which gives exposure to those non-Mag 7 stocks, which again trade on a big discount. For some good reasons, but still a big discount to the Mag 7. So, yeah, opportunities.
Let's leave it there for phone calls and emails. Martin Cobb will share his new top picks. That's coming up next. Tomorrow on Market Call, Mike Philbrick with us on the show, CEO of Resolve Asset Management. He'll take your questions on exchange-traded funds. And if you missed Market Call, you can check out our daily podcast, find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Time now for new top picks from Martin Cobb. We start with Kenvue, KVUE, on the New York Stock Exchange. Which is a spinoff, I guess, from Johnson & Johnson, and they have some very well-known products. Why do you like this stock specifically?
Yeah, firstly, I think it's the worst named stock that we own.
Where did that come from?
It's a portmanteau of Ken, Scottish for wisdom, and view, French for insight. Kenvue. All right. I mean, that is terrible. Okay. That aside, I like the products. I mean, so it's a new name, a new company to some extent, but you open up your medicine cabinet or your medicine drawer, the chances are You're one of the 1 billion people in the world who's got their products in there. So they have, cough, medicines, Tylenol in terms of painkillers, Listerine, Nicorette, brands we all kind of love and use on a daily basis. We were attracted to it on a standalone basis because it being spun out, and spin-offs tend to, pique my interest to some extent. Then you've got all the controversy surrounding Tylenol, and the Trump administration has said the talc litigation, which in North America is Johnson & Johnson, but outside it remains with them. But these are great brands. I mean, there's been real pressure on consumer packaged companies because of the Me Too products, the private label. That doesn't really apply to their portfolio because you don't tend to go for private label cough syrup and et cetera, although you can do for Tylenol. So the stock on a standalone basis trading a very attractive multiple compared to the likes of Procter & Gamble or a Colgate Palmolive. And then you have Kimberly-Clark has come in. I made an offer for them. So we did quite a bit of work on Kimberly-Clark, which is more the paper tissues, toilet roll, et cetera. And it looks very attractive. It's mostly an all-share deal. So we like ChemView on a standalone basis, put it together with Kimberly-Clark, which will be consummated the deal most likely sometime next year. You've got, I'd say, a more attractive stock on an even lower multiple. So you're buying the blended company on something like 14, 15 times earnings today. I think it deserves to be a bit higher than that. It could easily get a 20 times multiple, given the quality of the brands. And these are essentials, and they will not be competed away by AI, as far as I can tell.
Can you see those two companies with what they own coming together easily?
They do very different things in terms of the manufacturing side. So there'll be some synergies on the manufacturing side. You're not going to make cough syrup and
diapers
in
the same
place or with the same inputs. There will be some benefits in terms of selling. So you'll have some power to negotiate better with the likes of Costco in the world. But ultimately, there should be little execution risk in terms of putting the businesses together. Some, harmonization of manufacturing, possibly, but ultimately a little bit more scale, a little bit more bargaining power with your customers.
Your next pick is an interesting one. Starbucks, SBUX on the NASDAQ, which launched a major turnaround effort. Are you beginning to see some results from that effort? They closed some of their locations. They sort of redirected staff. They've tried to modernize a bit with sort of the digital boards, that kind of thing. Are you seeing results in earnings or anywhere else from the efforts put in?
You're starting to. I mean, Brian Niccol came in, and I remember the stock moving up over 20% in one day. And I'm never one to put a huge stock in management. But he's coming with some, I think, pretty sensible. The problem with Starbucks was just the customer experience in the US, which is by far the most important market for them, was just they were alienating customers. They got away from that third place kind of community feel. The amount of things you could have in terms of what you wanted in your cup. I just drink black coffee, so I always get annoyed when someone gets all those shots.
And it's confusing, too.
It's confusing.
They'll ask you 7 questions before you can get your coffee.
Exactly. Yes. But I was at Starbucks this morning. I still like to go to Starbucks. I had the warmed up blueberry muffin, which I love, and that, I'm fairly simple. So he's getting them back to basics or back to Starbucks, which sounds a bit jargony, but there's evidence that the US business is starting to stabilize. We actually saw that in the previous quarter. And then they're dealing with China. China was 13% of profits at one point. Today it's about half of that, but they've done a JV with another business, a local operator, which seems to be fairly sensible. To me, Starbucks, all they have to do is just get back to offering what customers want, get back to the community feel, drive the revenues again, and then get back to something like the average operating margins they've achieved, the mid-teens. You have $5 per share in earnings per share. It's an $80 share price.
Is it back to basics kind of look that they need?
Yeah, they need to get away from the menu complexity, just simplifying that. The wait times, there's a focus on how long, to focus on how long from when you're ordering to when you can pick up your coffee, even to having just available seating. It's not rocket science. It's not an easy fix, but it's not rocket science. They have a wonderful market position in terms of market share, roughly 1/3 in the US, higher in some other markets. So while it won't be an overnight fix, there's a lot they can do, being sensible, get away from the management consultant type way it's been run in the past, and get back to what Starbucks is good at.
Okay. Let's get to your third pick, CN Rail, so Canadian National Railway, CNR on the TSX. I know the rails have been pushed down a lot. I would imagine tariffs are part of that play with transportation logistics, things uncertain of when and where they're going to go some days, depending on what's happening in Washington. So the railways are down. CN Rail's at 132 today. Do you feel like it's going to come back? And if so, why?
Yeah, you look at that 5-year chart and you can see how much the stock has fallen. What hasn't really changed is the business. Yes, they're affected by tariffs today. Previously, they were affected by wildfires, labour disputes.
Demonstrations.
Demonstrations, government interference. They've been around for over 100 years. This stuff comes and goes. It waxes and wanes over time. Going back to my point in terms of apathy, there just feels to be apathy around both these and CPKC, which we also own. This one is slightly cheaper. So looking around the market today for attractive businesses that we believe are great economic moats, quality businesses. Yes, there's choppiness from time to time in the short term, but ultimately you're buying an over 100-year-old asset, which is irreplaceable. It will get through this tariffs. We'll get back onto some level of growth in both the top line and the bottom line, and you're paying 2/3 the multiple which you were 2 or 3 years ago. Why not buy it?
Okay, the high for CN Rail was last November, so pretty much a year ago at 156.34, and as we said, it's at 131.92 or 93 today. And so you think there's room to come back? Is this one you, because Donald Trump's going to be in office for the next 3 years, are you concerned at all about that as the overhang?
It's already in the price. My view is that, we have a long-term view. You have to have a long-term view. And when you buy companies, you can have good news and cheap share prices, but you can't have them at the same time. So here we have, I'd say, some fairly bad news, but I don't think it's actually that bad in the long term, and a cheap share price. The risk reward is very compelling.
All right, Martin Cobb, got to leave it there. Thank you for coming in. Good to see you. And thank you for joining us today on Market Call. We'll see you back here again tomorrow.